Hi, this is PR Sundar. Welcome to Mission Options Series 2. This is going to be the very first video. First, let me explain. In normal life, we use the word buy and sell. But in stock market, we don't use the word buy or sell. We use the word buy and sell in a cash market, equity market. But when it comes to futures and options market, we don't use the word buy or sell. We use the word long or short. Long means buy, short means sell. Now the question is why? Why there is something different? The reason is very simple. In all other markets, if you want to sell something, you should have it. You want to sell an apartment, you should have the apartment. You want to sell a gold, you should have the gold. But only in stock market, you can sell even without holding anything. Say for example, you do not hold any Reliance shares, but you can still sell Reliance shares. So that is why they don't use the word sell, they use the word short. And same thing for buying, right? So in futures and options, whether you are buying or selling, it is actually not the real physical buying or not real physical selling. It is just an agreement to buy and agreement to sell. So that is why we use the word, instead of using the word buy, we use the word long. Instead of using the word sell, we use the word short. So understand the basic thing, okay, buy means long, sell means short. So that's one thing. Now from here onwards, I'm not going to use the word buy or sell, I'm going to use the word long or short. Okay, so first strategy is called long call option. Long call means what? Buying a call option. So who will buy a call option? So if you think market will go higher, then you can buy a call option, and when the market goes higher, you will get benefit. So in fact, today it is the 22nd of February 2024. Yesterday night in US markets, there is a share called NVIDIA. So it was supposed to declare the results yesterday, and the people expecting good results. So people expected stock may go higher. So I bought a call option. So I will not use the word I bought a call option, I long call option. Okay, so it was trading around $680. So I bought $680 for call option for $40. Okay, now after the good results, so the price has shot up to $760. My $40 has gone to $80. I almost doubled my money in just one day. However, there is a risk. If the result is bad, if the price has come down, then my $40 might have gone to $30, $20, $10. But no matter how much market falls, my loss is limited to that $40. So in Indian context, let me explain. Suppose you are very bullish, you want to buy a call option. Let us say now Nifty is trading around 22,200. So you want to buy a 22,300 call option. Maybe let us say it is trading around 50 rupees. You buy that call option. If the price goes higher, okay, this call option price will increase, you will get benefit. But on the other hand, if the market crashes, let us say market crashes 20%, 30%, you still don't have to worry, because whatever the premium that you paid, 50 rupees, that will be your maximum loss. So in a way, call option, buying a call option or long call option, you do it when you find that markets are bullish, number one. And number two, the question comes, if you are bullish, why not to buy the futures? The problem in buying in future, tomorrow if Nifty goes up by 100 rupees, you will get 100 rupees profit. But if Nifty goes down by 100 point, you will lose 100 point. So your profit and loss both are equal. Possibilities are there. But in options, you buy a call option for 50 rupees, If the market crashes, no matter how much market crashes, your maximum loss is only limited to 50 rupees. But if market goes higher, and you may gain. So, if you do not want to take high risk, okay, and if you are bullish about the market, so you can go and buy a call option which is called long call option. And of course, there are some plus and minus points are there. So, when you buy a call option, the market really have to shoot up. If the market, going slowly, right, and then, because of time value, the money that you paid 50 rupees will start eroding. Of course, there is a plus point and there is a minus point. Now, I am going to give you some specific example. Look here, Nifty today it is trading around 22,358. So, this video is shot on 5th of March. Nifty is trading around 22,350, 360, and if I believe that market will go higher in the month of March and market will go significantly higher than 22,500, then what I can do? I can buy a call option of 22,500. Now, the payoff chart will look like this. Because I am bullish and therefore I am buying a call option, if I buy a call option, the market should go higher. If market go higher, then only I will make profit. But market goes lower, I will lose. However, you can see here, the maximum loss is equal to the premium paid. But remember, the premium paid here is almost 12,886 rupees. And that will be the entire loss. In case if market goes higher, you will get an unlimited profit. And also remember one thing, I believe that market will go above 22,500. Sometime market may go above 22,500, I still can lose. That is why we call it as Operation Success Patient Debt. You know why? Because to buy this call option, we are paying almost 260 rupees. So, market going above 22,500 is not enough. The market should go 22,500 plus 260. That is 22,760. So, even if market goes higher and goes and close around 22,760, still we don't gain anything. Nifty will have to go beyond that level because you believe market will go above 22,500, that's a strike price. But you also pay the premium. That premium will not be coming back to you. So that is why your break even here is 22,758. So you can buy 22,500 call option only if you believe that market will go above 22,758. So this is the payoff chart, limited risk, unlimited reward. Okay, now I am giving you one tips. Please don't blame me if this is not working, but many times I have seen this has worked well. In a particular day, assume that market is closing at the highest point of the day. Then what usually people will do, they will buy a call option. So that probably the next day market will open higher. So you may go and do some kind of a back testing and see how many times Nifty closed at the highest point of the day and what happened on the following day for the people who bought the call option. So what are the scenarios you can buy call option? As I told you, something like this is one. Second thing, just before the results. If you are expecting the results to be too good, okay, and you can buy a call option, and however, sometime results may be good, stock may go higher, but you still may lose. That's because, after the results, the volatility index will collapse. So the results has to be really very good for you to make money. So when people expect a very good results, people buy call option, or When the market closes at the highest point of the day, they will buy the call option to make some profit on the next day. And in general, if you are very bullish about the market, in the short term, if you think market will go higher, and the people buy call option. So this is called long call. And however, one caution, there is something called market efficient hypothesis. Whatever everybody knows, whatever everybody knows, that is factored in already in the prices. I'm just giving an example. So if I ask you, who is going to win the parliament election in 2024? What will be your reply? Your reply will be surely BJP. Right. So if BJP comes to the power for the third time is a record, okay, markets will be good. So therefore, if you want to go and buy a call option, I will advise you don't do that. Why? Because is it that only you know that BJP will be winning? Nobody else in India knows? In fact, that is the majority people view. Right? So that's what we hear from all the channels, media. Right? So when everybody knows something, so that is already priced in. That is why in the last 3 months, Nifty has already shot up more than 3,000 points. Okay, so therefore, even if BJP wins in the parliament election, stocks may not go very much higher. Maybe temporarily 2-3% may go higher. After that, it may fall. And I'll give you the best example. In 2014, everybody expected BJP to win, right? And BJP won. So markets did not react much. I think it went up 1 or 2% only. 2019, once again everybody expected BJP to win and they won. So it was not a surprise. So markets did not go up much. It was up only 1 or 2%. But in 2009, everybody expected a hung parliament, but Congress won. So market shot up 20%. So therefore, I can tell you, this time everybody is expecting BJP to win. If they win, markets may not go much higher, maybe 1 or 2%. But in case if they lose, market can crash 20%, 30% also. So that's it for now. Hope you enjoyed watching this video. Thank you for watching.